Good evening and welcome back to the latest edition of InvestTalk Market Analysis for the week ending October 28th, 2022. Appreciate you all tuning into this channel and subscribing to our podcast, InvestTalk. Now, this week I'm going to title the video, Bulls Take the Reins Despite Bad Tech Earnings. And we'll dig into those charts here in a minute, but I'm going to start off as usual with our economic data. Monday, we had the Richmond Fed Manufacturing Index down 10 into negative territory, negative 10, which, it hasn't been that bad since outside of the COVID crisis since '08. Right, hasn't been that bad. I guess 13 it dipped in there a little bit, but what you can see here is the economy is weakening. That was the first sign, and then the second, or on Tuesday, we found the new single-family home sales month over month down 10%. Honestly, not shocked it was. Actually, shocked it wasn't worse because of where interest rates are. Mortgage rates now above 7%. So actually, this is a relatively good number overall. The Kansas City Manufacturing Production Index, that was negative 22. Yeah, this was the one that was the lowest since '08. Okay, so these hit the mid-teens, but last time we had in the 20s was 2009, outside of the COVID crisis. So another indicator that not only is the economy weakening, but the strong dollar is hurting our manufacturing sector. Now, we also had the real GDP number come out on Wednesday. That was up 2.6%, mainly driven by exports in a big way. Usually exports are a drag on our economy. Net exports, right? They call net exports because we're importing more than they're exporting. But in the second quarter, and especially this third quarter, we exported a lot. And you're going to go, why did we export? What did we export? The answer is simply oil and natural gas, mainly natural gas, right, over to Europe. So this is kind of an anomaly, just like the first quarter was kind of an anomaly, and it was a reversal of inventory builds in the fourth quarter. This is also kind of an anomaly to the upside. So you really have to look into the details of these GDP reports because they encompass so much, and big unique factors in times like this can really change the data and change the headline number from the underlying trend. If you look at the underlying trend of spending, for example, by individuals and businesses, it was flat, 0.1% on an annual basis. So not a recessionary number, but certainly a stall speed economy for the third quarter. And that's how I'd probably describe the economy overall. Now, the U.S. durable goods orders, once again, kind of another stall speed number, a little bit tick up, so that was solid, but nothing to write home about. On the price front, you definitely got some help here. Look at the GDP purchase price index. That was only at 4.6% for the quarter, down from 8.5% in the second quarter. The last time we were that low was, the fourth quarter of 2020. Well before inflation started to accelerate. The core PCE price index, that was flat month over month, so not showing an acceleration at least. And then employment cost index, that's come down for the second month in a row. And then personal spending stayed relatively robust. So if you had, a stall speed, slightly positive economy, but inflation pressures easing, I think that's kind of what the Fed wants. And so that's really what you saw today. Stall speed, but with some factors that are looking in negative territory, like the manufacturing indices, like I said. So let's pivot over to the charts here. Excuse me. We're going to dig into, let's see, this one's due. There we go. All right, here's the S&P. Now we had tech carnage throughout the market this week. You had Meta. We'll just go over those first. Meta sinking, down 20% after earnings. You had Amazon down big after earnings. You had Google down big after earnings. And Microsoft even had not a terrible quarter, but not new lows, but definitely was down after earnings. All saw slow trends in their business, and Apple was the only one that really was able to buck the trend. I've said this for a long time, over a year now, that of the FANG names, Apple's going to be the most resilient and probably the best place to put your money if you want to invest in large cap tech, which hasn't been our place to make a big bet. But if you did want to be in that space, Apple's continues, I think, to be the leader, the standout, in the market action kind of tells that. Now, if you look at the growth to value side of the market, you had growth outperforming or underperforming, this week, and in a big way after all these earnings announcements. So just a continuation of the downtrend. It was concentrated in the ARK funds, right, and all the no profit small caps. Well, now it's spreading to the generals of the market, right? The still profitable companies for the most part, but slowing and weakening profitability, and that's difficult. When you have companies that are priced for perfection with high multiples, like those FANG names, just a slight miss can really send the stock stumbling, and that's what they did. Let's look at the VIX real quick. Here's the VIX. We talked about this being in decline, not making new highs. It was kind of a tell that we're going to probably enter some sort of an uptrend. It might be only for a matter of a few weeks or a few months, but that's what we're in. We're in an uptrend in the market. Let's pivot over to the S&P, and we hit the 100-day moving average rather quickly. And the S&P has been one of the weakest. You remember, because they're very top heavy, very exposed to Amazon and Google and Microsoft and the like, and so the other indices, the Dow. Look at the Dow going from lows of around 28,500 now all the way up north of almost touching 33 and above the 200-day moving average. And if you look at the small caps, that's well above the 100-day moving average, and getting ready to attack that 200 here pretty soon. And remember, last time that was a resistance. Look back in August, there was resistance to the upside. Typically, when you hit that area once again, it's going to be not as strong. It's already hit it once, so it would not shock me to see this retrace. Here are the fib numbers or fib lines on the weekly chart. And you can see here, we've already kind of tested the 50-day. Do we get all the way up to the 618? I think that's certainly a possibility that you have to keep open, especially since we're entering into seasonally a pretty good time for markets, especially into New Year. Monday is Halloween, and then Thanksgiving a few weeks after that, and then you get into holiday shopping season and the Santa Claus rally. And so with how bad sentiment was 2-3 weeks ago, and now you're getting short covering rally, you're getting vol targeting funds adding back exposure, you're getting a lot of positive rebalancing, gamma squeezes, etc. All that is just kind of getting started, and so the odds, I think, are pretty good that we continue to the upside, whether that's warranted or not from the economy, what the Fed's doing, etc. That's TBD, and there's certainly room for more downside next year. But did we see the ultimate lows? I've said pessimism 3 weeks ago was horrible. So I've been calling for this rally, and so far I've been vindicated. I kind of still call for a rally. No guarantees, especially with the geopolitical situation that we're dealing with. Anything could happen. And then we have the midterms here in under 2 weeks. Unlikely to really cause any major change to sentiment or market expectations. But once again, seasonality in the midterm election season, after elections, market tends to go up. So you're getting all these things lined up, and that's what this is about. It's not about trading off of one particular data point. It's taking it all in context. It's why you have to think dynamically, and that's what we're trying to do. So there's that. Let's pivot over to the currencies. So it's another thing that got the market kind of juiced up a little bit is, say, the dollar. It's still an uptrend, but certainly showing some weakness. I called this out over the past couple of weeks that, interest rates are making new highs, but the dollar wasn't. And that was kind of a tell that, we're getting close to at least the consolidation phase. And I believe I highlighted this, which was the fib retrace from all the way back as the 10-year, the highs back in 1981, when interest rates, the 10-year was up over 15%. Imagine that, 15%, all the way to the COVID lows. And now you get this major resistance level at that 2.5 retrace. And so not shocking to see this enter some weakness in a consolidation phase. And I think that's probably what it is. And I think we eventually go higher. But we'll certainly keep an eye on that. But I wanted to touch on that and just show you, lower rates, weaker dollar, certainly going to be help for the market, and room for a little bit of optimism on that front. Now, certain sectors continue to do very well. Here's energy. Industrials had a big comeback here with the weak dollar. But XLK, still an up week, but obviously weighed down by those big tech names. And, Apple is the biggest weighting. So luckily for these indices, the Qs, right, look at still well below the 100-day moving average. The S&P's at the 100-day, the Russell's above the 100-day, ready to attack the 200-day. So very different looking charts, very big divergences here, and you can see that if you pay attention to those trends. Now gold didn't get quite the lift, but commodities overall, here's DBC, that did get a little bit of traction this week. Not as much as you probably would expect, though. So something to keep an eye on. Now, what was positive was GDX had a nice week, closed above the 50-day, and ready to attack that 100-day. And the silver to gold ratio, that one continued to march higher and begin that uptrend. So overall, just kind of a relief week. And we have Fed week next week. It's going to be all about what they say about December. It won't be about the 75 basis point hike that they're almost likely going to do. And the market may continue to react bullishly to just moderately more dovish Fed speak, which is kind of what you got late last week and this week, kind of from the Wall Street Journal and their leaks. So that's where we're at. I appreciate you all tuning in. I hope you have a wonderful weekend. And a reminder that the contents of this video are for educational purposes only. Should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Thank you and have a good night.